Good evening and welcome to a special edition of Modern Wall Street. We're here at the New York Stock Exchange on the eves of the jobs report for the latest month, and we are joined by Stephen Guilfoyle of Sarge 986. He'll give us his expectations for the equity markets and tell us what he expects for the Fed meeting next week. Hi, Stephen. Great to have you here today.
The pleasure's mine, Remy. Thank you for having me.
Well, we did get that stronger than expected ADP employment report, and we're here on the eve of the employment report. Now, given that we had the Fed meeting next week, what are your expectations? And if those expectations aren't met, what does it mean for the equity markets?
Well, that was some blowout for the ADP, wasn't it? I started out thinking we'd get about 190 on the non-farm payroll number. I guess the risk would be to the upside in that number at this point, being that the ADP and the NFP have run pretty much hand in hand when smoothed out as an average for quite some time now. Really, more than a year, they've run very close to each other. However, I think the real focus will be on wage growth. We had kind of a slowing down of wage growth for January. I think we want to see at least a 0.3 month-over-month print for the wage growth. We want to see participation at least hold its own. We don't really care what the unemployment rate does because it's not important to anybody in the industry. Underemployment is important. We want to see that number drop from the 9.4% that the BLS had seasonally adjusted it to last month. As far as the Fed goes, it's baked in the cake. All right, we're going to get a quarter-point rate hike next Wednesday. I'm relatively certain of that. The markets have probably priced in about a 3/8 of a point rate hike, so we're probably on to what would be a June hike in some way, in both the debt market and the equity market.
Well, Stephen, now that you've covered your expectations for the jobs report as well as next week's Fed meeting, I want to move on over to commodities. Now, this week we've been seeing a mostly stronger U.S. currency, and we've also been seeing lower oil prices. WTI and Brent were both lower today, WTI breaking below 50. And we all know that there's this tug of war between U.S. inventories as well as OPEC's output cut agreement. So where do we go from here?
All right, oil's obviously the hot topic right now. It's hotter even than the Fed. Now, the $50 level is important psychologically and technically. It broke this morning. It broke hard. Most people weren't up early in the morning, but it went straight from 50 down to below 49. Throughout the course of the morning, it got back up there. It tested 50 again, and it went back down and tested 49 again. Technically speaking, I believe that 50 is a doorway to 46. I think we can trade between 46 and 50 on a technical basis. However, as the price goes down, production also will go down. So the gigantic inventory numbers we've seen might not grow as wildly as they have in recent weeks. I think it's actually, maybe it's not the time to go all in and buy oil, to buy energy names, but it certainly is a time where you want to start nibbling away. I myself have sold some tech names and nibbled away at quite a few energy names today.
That does make sense given where energy prices are today. Now, I know that most people don't usually pay attention to the G20, but we do have central bankers and finance ministers meeting at the end of next week, and this will be after the Fed Reserve meeting. And this will also be the first meeting where U.S. Treasury Secretary Mnuchin will be attending. What are your expectations for that meeting?
You know, I guess for the secretary, it's going to be a learning experience. And I do have a lot of confidence in him, however, more so than I've had in any Treasury secretary in quite some time. As for the world in general, there's a lot of funky things going on in China right now. China is really a big deal. Inflation just rolled off a table, consumer level inflation. The import number was really high, which suggests a lot of commodity buying and a lot of demand, but the inflation number didn't support the demand. So as far as China goes, I think we're probably looking at at least in the short term, an era where they're going to do their best to try to support that 6.5% GDP target, and they're probably going to have to do what they did in the old days and rely more on fiscal spending than anything else to get that done.
And Stephen, last but not least, before I let you go, I do want to shift our focus on over to DC. Now, of course, the Fed meeting is taking place next week, and in terms of politics, you never know when we'll get a tweet or an update that will affect the geopolitical climate as well as the financial markets. But given what we've learned about healthcare and the future here in the U.S. for reform, where do you stand for that sector?
Healthcare is very confusing right now. I would definitely shy away from pharma, from biotech. anything like that. The president seems to be having I wouldn't say an all-out war with those groups, but he certainly isn't comfortable with those groups. They're going to be under the microscope. So maybe you want to stay away from that. As far as medical technologies, the Becton Dickinsons of the world, I think that's probably, if you need to play the space, because the healthcare sector has, until this week, really been pretty good all year. If you need to play the space, you got to stay where the quality is.
Okay, Sarge, well, great to have you here ahead of the jobs report, and as always, thank you so much for insight and analysis.